Hello, everyone. This is Terry with Futures IO, and as always, I would like to thank you for joining us today. It is my pleasure to welcome back Al Brooks for today's webinar, Trading Patterns on the Open. If you have questions, please feel free to type them into the questions box throughout the webinar. We'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to the channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @FuturesIO. And now, without further delay, I will hand it over to Al, and you'll get the pop-up again to share your screen.
This is Al Brooks. Thank you for watching this video. This is a re-recorded presentation that I did for Futures IO yesterday, October 30th, 2018. The audio on the GoToWebinar recording was not as clear as I would like it to be, so I'm recording it again. First, I want to thank Big Mike and Terry for inviting me, and I also want to thank you for spending some time watching this video. I'm going to be discussing patterns on the open. Everybody wants a trend from the open, but a trend from the open that lasts all day happens only about once a week, 20% of the days. 80% of the days have some kind of reversal on the open in the first 60 minutes, the first 90 minutes. I'm going to begin by talking about how I think traders should enter their trades, where they should put their protective stops, and how they should exit. I have a collection of about 100 patterns, and I have 4 variations of each pattern. I have a buy and sell version, and I have a successful and a failed version of each pattern. This set of 400 patterns with many examples of each is available to traders as an add-on if they have already purchased the Brooks Trading course. Today I'm going to be talking about a gap down open, a gap from either yesterday's close or below the moving average, and then a buy climax that reverses back down. Next, I'll talk about a gap down and a buy climax up to resistance like the moving average. But instead of reversing down and forming an early high of the day, the reversal fails and becomes a bull flag, and then the bull trend resumes. Next, the third pattern, I'll be talking about a gap down and then a sell climax. The market gaps down, it sells off sharply and reverses up. And finally, I'll talk about a sell climax that tries to reverse up, the reversal becomes a bear flag, and the bear trend resumes. I want to begin by talking about a gap down and a trend from the first bar. For a gap down open, what I'm talking about is the open of today being either below yesterday's close or below the moving average, and a gap up is opposite. When there's a gap down and you get a trend from the open bull trend like this, you only see a gap down and a trend up or down on the open about once a week, 20% of days. If you see it, and you have a couple bars, one of them being a big bull bar closing on its high, traders will buy with a stop one tick above the high of that bar. As long as the market keeps forming bull bars closing near their highs, traders will have plenty of opportunities to buy again. They can take the first entry. If they take a profit, they can look to enter again. If they don't take the first entry, there are plenty of other opportunities to buy at any point during the day. You keep doing this until there's a reason to suspect that the strong trend has ended. For example, there's often profit taking in the final hour. So if there's some kind of a top, here a parabolic wedge top or a micro double top, buy climax, pullback, second buy climax, and then a bear bar, traders will exit. Next, I want to talk briefly about a gap down and a bear trend from the open. Again, only about 20% of the time will there be a trend from the open, up or down. Here we have a series of bear bars. After the first 2 bear bars, with one or both having decent sized bodies and closing near the low, traders will begin to sell closes or sell below the low of the prior bar. For example, you might sell with a stop 1 tick below the low of that bar. As long as there's a strong bear trend in effect, traders will sell bear closes of any bear bar, or they'll sell below the low of the prior bar if the bar closes below its midpoint, especially if it closes near its low. And they'll keep doing that as long as the trend is reasonably strong. Typically, if you have a strong series of bear bars on the open, it will result in a measured move. And one measured move that I like to find is one based upon the first series of bars, and then there's a pause bar, a bull bar. I expect a measured move down from the open of the first bar of the series to the close or low of the final bar of the series. Here's the close of the final bar. Here's a measured move, and that would be a target, a good profit-taking target. And you can see when the market got down to that target, there was some profit-taking. 80% of opens have reversals. The reversal can be immediate. So for example, if you have a very strong sell-off, 50% chance you're going to get the reversal immediately. No matter how strong an open is, 50% chance it's going to reverse. Typically, the reversal will take place at support or resistance. Here we have two big bear bars closing on their lows or near their lows, but we get a reversal up, and those bear bars formed a sell climax in the low of the day. And here's the opposite. On the open, we gapped above yesterday's close, we gapped above the moving average, and we have three decent-sized bull bars, yet as strong as the rally was and as strong as the trend from yesterday's low was, it reversed down. So if you see any strong opening, don't become convinced that there's a trend underway. 50% chance you're going to get a reversal. Here's a collection of opens to illustrate some points. 80% of the days, there's a test of support or resistance in the first 90 minutes, and you get a reversal. And that reversal often becomes the high or low of the day. And I call that reversal an opening reversal. Remember, only 20% of the days does the market open and trend for the rest of the day. I am not talking about these days today. I'm talking about the other 80% of the days when there's some kind of reversal. Typically, when you get a reversal, if you're getting a reversal down, it'll come from a wedge top or a double top. If there's a sell-off on the open, you should be looking for a reversal up, typically from a wedge bottom or a double bottom, and sometimes you get both. For example, we have a parabolic wedge rally and then a double top, and we got a reversal down. Here, a wedge bottom and a reversal up. Bulls will buy above a bull bar closing near its high. That one, that one, that one. Any of them is fine. We have a gap down, a rally to the 20-bar exponential moving average, and a wedge top with a decent bear bar. Traders will sell that. The bulls tried to resume from a higher low. Instead, we got a double top. Traders will wait for a bear bar closing near its low or for a series of bear bars, and then they'll sell. So here we have two opening reversals down. We have a wedge rally and then a double top. We tried to get an opening reversal up. There was a wedge bull flag, a double bottom, and that failed. We have a gap up and a rally, a sharp sell-off, but it formed a double bottom bull flag at the moving average. Traders will buy with a stop above a bull bar here or here. So on the open, look for double tops, double bottoms, wedge tops, wedge bottoms. Sometimes the first reversal will fail and you'll get an opposite reversal. I want to talk a little bit about trade management. Traders should be entering most of their trades using stops. And to increase the probability of a profit, wait for a strong signal bar. For example, you could sell below this bar, but it has a big tail below. I would call that a doji bar. However, we have a bear bar closing on its low here, and it's a higher probability of a profit selling on a stop below this bar. Here we have another bear bar closing near its low, and we're in an early bear trend, a tight bear channel. you sell on a stop below that bar. Another bar closing near its low, here on its low, sell on a stop below that bar. When looking to buy, we're getting a reversal up here. It's better to be buying above a bull bar closing near its high. Here we have a bull bar closing near its high, and the entry would be 2 bars later. Here we have a bull inside bar closing near its high. We have 3 bull bars. Traders will buy above that bull bar, get filled here. Bull bar closing near its high, they could buy with the stop above that bar and get filled here. They could buy closes, or they could buy with the stop above the high of the prior bar. For a protective stop, you put your stop just below the bottom of the reversal if you're buying, and above the top of the reversal if you're selling. It doesn't matter which of these entries you take, the stop is the same, the bottom of the bull trend. Even if you take the second, third, or fourth entry, even if you're entering several bars after the initial signal bar, your stop is below the bottom of the rally. And if you're selling, the opposite is true. Here we have a sell signal bar, but the stop goes above the top of the rally. Here, the sell signal bar, you enter here, it goes right above the sell signal bar. And that's true for any of these entries. If you sell here, you'd put your stop either above that bar or above here, the top of the swing. And the same with this. If you sell here, you could put your stop here, but it's probably better to put it here or even here. And when you buy, same thing. Any of these buys, stop here. Buy here, stop here. Buy here or here, stop here. When you're starting out, you should be looking for swing trades. And you should take mostly swing trades, and that means you'll be looking for 1, 2, or 3 trades a day. After you become consistently profitable, then you can start looking for other minor trades, scalps, and possibly take 3 to 10 trades a day. As I said, I created a classification of patterns for swing traders, and there are 4 versions of each. There's a buy pattern, a sell pattern, and then a failed buy and a failed sell. And I have about 100 classic patterns, and that means I have about 400 total sections in my series of PowerPoints. This is not part of the Brooks Trading course, but people who have the Brooks Trading course can buy access to these slides. And I keep adding to the collection every day. And right now, I probably have well over 2,000 slides, maybe 2,500 slides, multiple examples of each of the patterns. The importance of it is if you can recognize what the market is doing, you can look for examples of that pattern to get an idea of what might follow. So if you see a wedge bottom and you want to know what kind of reversal to expect, you can look at the collection of patterns and find one similar to today, and that will give you an idea of what to expect. Now I'm going to move on to the patterns. First, I want to begin with a gap down, and then a rally to a buy climax, and then a reversal back down. We have a gap down below yesterday's close and below the moving average, and we have a strong rally. Yet, it was a buy climax that led to a reversal back down. You can buy as it's going up, but you have to be prepared to sell on the way down. Remember, no matter how strong any trend is on the open, it's going to reverse 50% of the time. No bear bar for the first 9 bars. Strong buying pressure, so a strong bear trend is unlikely. If we get a reversal down after such a strong open, either it will lead to a bull flag and a bull trend, or a sell-off that will become a trading range. In other words, you'll get a rally later. 2 legs up. We had a weak rally with 3 pushes. 1, 2, 3. So the bears wanted a parabolic wedge bear flag at the moving average. Instead, we got a breakout. However, the breakout failed. Therefore, I call this a 2-legged trap. We have a first leg up, an attempt at a bear flag, and then we have a breakout. But instead of beginning a trend, it trapped bulls into hoping there would be a trend. And then in addition, we have a micro double top. We went up and then down. We went up again and then down. The bulls who bought this close or above this high were disappointed by this bear bar, and they used this bar to get out break even, and that began a bear trend. Traders can sell possibly below that low because it's already a micro double top. We went up and down and then up, and we're trying to go down again. Or you could wait for a second entry sell, for example, below that bar, or you could wait for a sell below a bear bar closing near its low, like here. The sell-off became a bear leg, and what ended up as a trading range day. We have a bull leg, a bear leg, a bull leg. We have a gap down open below yesterday's close and below the moving average, and a pretty strong rally. 2 legs up. We went above yesterday's high and reversed down. You should always be paying attention to yesterday's high and low because the market often tests it and reverses. Sometimes it'll reverse down from just below yesterday's high, sometimes from just above, and sometimes the market will test yesterday's low and reverse up. We have a buy climax and a second buy climax, a failed breakout above yesterday's high, and a low 2 attempts to go down. Here's the first, here's the second. You could sell below that bar, but a prominent tail, a doji bar, higher probability looking to sell below a bear bar that closes below its midpoint, for example, below that bar. And as long as the market is going down, traders will sell below bear bars that close near their low. Here's a big bear bar. Why would I not sell below that bar? After you've had 4 or 5 bars, if you suddenly get a very big bar, you're probably going to get profit taking. So I typically do not sell below that bar. Good reversal up. Reasonable for the bears who took any of these shorts to exit above that bull bar or above a second entry reversal up here or here. I said sometimes you get a gap down and a rally that is climactic, but instead of getting a reversal down, you get a bull flag and the bull trend continues up. Gap down, strong rally. The bears tried to get a second entry sell, first here, second here. The bears tried to fail in the reversal up from below yesterday's low. Instead, we tested yesterday's low again, and we got a bull trend. So gap down and a buy climax, and attempt at a reversal down. Instead, it became a bull flag. Remember, no matter how strong any trend on the open is, it will reverse 50% of the time. And 50% of the time, the reversal will fail and the bull trend will resume. Big gap down, bull bar closing on its high. It's reasonable to buy there or above any of these bull bars closing near their highs. Here we have 8 consecutive bars on the open with bull bodies. There's actually a small bull body here, and that is extremely rare, and it represents very persistent buying, strong buying pressure. The bears tried to get the reversal down, and it's reasonable to take that sell. We have a buy climax pulling back to the moving average, and it's a second entry sell. However, you never can get married to a position. You have to realize on the open, everything that looks good only has a 50% chance of success. And at some point, you have to decide that instead of getting a reversal, it's a bull flag. You don't have to take this buy. It's only a small bull doji after 3 bear bars. But now we're getting a bull bar closing on its high. It's reasonable to get out of shorts and buy here. And then we're starting to get a series of bull bars, no pullbacks, bull bars closing near their highs. Traders need to get long. If they did not take this buy and they see another bar closing near its high, you buy above that, you buy above that, you buy above this. Any of these is a reasonable entry, but you have to get long. I said sometimes you get a gap down and a sell-off on the open. If it's climactic, traders will look for a reversal up. Here, we're gapping down below the moving average. not below yesterday's close, but below the moving average. And then the bear's got a double top below the moving average and a bear bar closing on its low, reasonable to sell below the bear bars. And when you see a bull bar, reasonable to get out because 50% of strong bear trends on the open will reverse. Here we have an II pattern. This bar is inside of this bar, and this bar is inside of that bar. Inside, this low is above that low. This high is above that high. We have consecutive inside bars. I call that II, inside, inside. It's a triangle on a smaller time frame chart. Reasonable to buy above the II, even though it's a bear bar. If you prefer, you can buy above this bull bar, or you can wait for a bull bar closing on its high and buy above that bar. And you can buy above any bull bar closing on its high as long as the reversal up is strong. 2 legs up to the moving average, 1 pullback 2, a bear II, reasonable to get out of longs here. Very strong reversal up. Unlikely that we'll get another strong reversal down. More likely, if we sell off, it'll be a bull flag. Whenever you have a reversal and then a bull flag, it's a cup and handle pattern. So a cup and a handle. And traders would buy going up here as well. You could also call it a higher low major trend reversal. We have a bear trend, a strong minor reversal, and then a sell-off testing this low, did not get near it. It's a higher low. You can call it a higher low double bottom. I call it a higher low major trend reversal, and traders will buy above that bull bar and above any of these bull bars. When you have a big sell-off on the open and you get a reversal, the day can reverse up for the remainder of the day. Typically, if the sell-off on the open is big and you get a reversal to a new high, you're not going to get much above the earlier high. I think of that as a trading range day, a leg down and a leg up and closing around the open. Here's the moving average, a big gap down below the moving average. Huge bear bars, but big bear bars, sell climax. You got to be thinking 50% chance we'll get a reversal up. A doji, not a strong signal bar, but here we're getting a second buy. First buy was above this. The bears were unable to resume down, and now we're getting a second reversal up. Higher probability to take the second buy, especially since it's an II, or if you want, you can wait for a bull bar closing near its high, here or here. Several legs up, buy climax, pullback, second buy climax, pullback, third buy climax, so parabolic wedge rally, and a bear bar, reasonable to get out below that bear bar or below consecutive bear bars with the second one closing near its low. Tried to reverse up on the open, and then we sold off sharply, a sell climax, and it was a test of last week's low. Every day likes to test something on the open. For example, it might test yesterday's low. Sometimes it tests last week's low or last month's low. Here's a test of last week's low and a very strong bull reversal bar. It's the second reversal up. We tried to reverse up here, and we're getting a second one here. The bears, if they sold here, they have to get out here, and bulls will start buying either above this bar or above that bar. It's a second leg trap. We gapped down and sold off, reversed up, and we sold off even stronger. The bears were hoping this was a breakout that was going to lead to a bear trend. Instead, it trapped bears into selling low. And if they sold this close or below its low, they never got a chance to get out. The market just reversed up sharply. They'd have to get out above this bull bar and take the loss. However, had they bought here, they would have more than made up for the loss had they sold this bear close or below that bear bar. 3 legs up, buy climax, pullback, buy climax, pause, third buy climax, and now a bear bar, reasonable to get out below that bear bar, a parabolic wedge rally. 3 legs up in a tight bull channel. The bears will take that short. And now we have a bear trend, a very strong rally, a strong minor reversal up, and we have a couple legs down and a micro double bottom with this low. It's a micro double bottom and a higher low major trend reversal. Bulls will start buying. Gap down below yesterday's close and below the moving average, and we sold off sharply below yesterday's low. 2 consecutive bear bars, one closing on its low, reasonable to sell below its low, but we're getting a reversal up from below yesterday's low. Remember, I said traders are always looking for the market to test yesterday's high or low and then reverse. And here we have a pretty good bull bar, and the bear bars are shrinking. Bear bar, smaller body, and now we got a bull body. The bears who sold below there, below here, or below here have to get out, and bulls will buy, hoping for a swing up. Shrinking bodies, 1, 2, 3, loss of momentum. And pretty good reversal bar. Bulls buy above that bull bar closing on its high, another bull bar closing on its high. Higher probability because now we have 2 consecutive bull bars closing on their highs, and this body is bigger than that body, so the market's accelerating up. Here we did not gap down, but we sold off strongly, so it's a sell climax on the open. We have a little bit of a parabolic wedge rally, 3 sell-offs, 1, 2, 3, and a bear bar closing on its low. Traders will sell below bear bars. And we've had multiple attempts to bottom today. We have a bull bar here, a bull bar here, and a doji bar here. This is a better bottom, a second entry, and a bull bar here. So bull bar, bull bar, bull bar. And inside of that, we have what I would think of as a wedge bottom. We have a spike down, 3-bar breakout, first leg. You typically get 2 more legs down and then an attempt at a reversal. So first leg, pullback, second leg, pullback, third leg, higher probability of some kind of reversal up. Reasonable to take that buy. It's probably only going to be a minor reversal because the bear channel lasted a lot of bars and the channel is very tight. Usually the first reversal up is minor. Sometimes it'll go up pretty far and you can make a pretty good profit. Other times you get immediate disappointment. As soon as you entered, your entry bar became a bear bar, and then you have another bear bar here. So it looks like we're not going very far up. Reasonable for the bulls to get out below a bear bar closing on its low, especially after 3 or 4 little pushes up. 1 pullback, 2 pullback, 3 pullback, and then a second entry short. Try to reverse here, try to reverse here, try to reverse there. So get out of longs. Bears will sell that, looking for a test of the low. Lots of prominent tails, lots of reversals. This sell-off is probably going to be a trading range, which means when it gets near the low, traders will look for another reversal up. Gap down below yesterday's low and the moving average. The bulls tried to rally, but weak. A small doji bar and then a small bull bar with a prominent tail. No close above the moving average. We got a reversal down. Bears will start selling. We have a 2-bar breakout, so a spike down, first leg, a pause, second leg, small bar, pause, third leg. So it's a parabolic wedge sell climax, and it turns out, if you looked on the daily chart, this reversal is right above the bottom of a gap on the daily chart. So you have a parabolic wedge sell climax reversing up strongly just above support on the daily chart. We have a micro double bottom. The bears who sold this close, disappointed by this bull bar, decided to get out break even or with a small loss. And those bears placed limit orders to buy around their original entry price. So micro double bottom, parabolic wedge, reasonable buy. Tight bear channel, so first reversal is minor. Traders will look for a second reversal and a swing up. Strong sell-off. It was just the price getting vacuumed down to test support. It got to within a tick of the bottom of the gap on the daily chart. Very strong sell-off. Most traders will wait for a micro double bottom and then buy. The micro double bottom represents a test of the bottom of the bear trend, and the bears who sold this close will use that to buy back their shorts. And then this is a sign of bears giving up. This is a sign of bears giving up. Bulls are getting confident and will look to buy. Small double bottom, micro double bottom. Good bull bar here, good bull bar here. Good context. a parabolic wedge sell climax testing important support, and now we have a micro double bottom with two pretty good bull bars, buy and a stop above the bull bar. We have a big gap down, the bulls tried to reverse up, and the bears tried to reverse down, possibly a trend from the open bear trend. Remember, only 20% of the time will it make it all the way to the end of the day. 80% of the time, it's going to reverse and form some kind of a trading range. We have a trend from the open bear trend, we get a reversal, and it ended up as a trading range day, a triangle. Lower highs, higher lows. Parabolic wedge, we have a reversal up, a second reversal up, a third reversal up. 3 bear bars, a lot of bulls will wait for a second entry buy, like a micro double bottom. This is the neckline of this double bottom, or they'll buy above a bull bar, closing on its high here or here. Strong minor reversal up after a big bear trend. We're far below the moving average, so it's a big bear trend, but a strong minor reversal up. Therefore, traders will look for a test of the low and then a major reversal. This was a higher low major trend reversal. It did not lead to a major reversal into a bull trend, but it's a reasonable buy. Gap down, failed rally, double top. Bears will start selling below bear bars. Lots of prominent tails below bars, and bad follow-through, bear bar, bull doji, bear bar, small bear bar, bear bar, small bear bar. A pair of bear bars, tails, doji. It looks more like a bear leg in a trading range. Traders will look for a reversal. Here we have a wedge bottom. You can also call this a micro double bottom. A bear bar, not a great buy. It's a second entry buy. Here's the first, here's the second. Better to wait for a bull bar closing on its high. Here we have a second entry buy, but it's a doji bar. 3 bear bars. A lot of bulls will not take this buy. They'll wait for a second entry buy. Here the second entry buy is a doji bar, not great. A lot of bulls instead will look to buy above bull bars closing near their highs. Gap down, tried to reverse up and collapsed. Traders will sell below bear bars closing near their lows. 4 big bear bars closing near their lows. High probability of at least a small second leg down, but you might get a reversal at that point. Most bulls are not going to buy this reversal up after 4 strong bear bars. However, if we get a second reversal up like this, especially with a micro double bottom, bulls will look to buy above bull bars, either here or here or here or here. We have a micro double bottom, we have a bigger double bottom, consecutive sell climaxes. Similar day, bear bars closing on or near their lows, bears will sell below those bars. And now we're starting to get tails and dojis. The sell-off is losing momentum. These are trading range type bars, so the bear trend probably will end soon and will probably enter a trading range or possibly even reverse into a bull trend. A series of sell climaxes here, and then here, and then here, and then here. Every bear bar or series of bear bars is a sell climax. And if you have a lot of them with bad follow-through and a lot of bars with tails below, you're probably soon going to evolve into a trading range, and therefore traders will look for a reversal up. We have a small wedge, 1, 2, and 3, that little pink line, and it grew into a bigger wedge. We have a breakout below the wedge, reversed up, but it formed a bigger wedge, 1, 2, and 3. Traders will look to buy a reversal up, especially above a bull bar closing near its high. Big gap down and sell off, and then a low 2 bear flag, low 1 below these bars, and then low 2 here, reasonable to sell. And we tried to get a bull flag here. We tried to get a higher low bull flag. Instead, we got a bear breakout, so 2 legs down. First leg here or here, and then a bear breakout for the second leg. The bears were hoping this was going to be a breakout leading to a trend. Instead, it led to a reversal. So it's a second leg bear trap. First leg down tried to be a higher low, and we got one more breakout, and second leg, a sell climax that reversed. You can look for either a reversal into a bull trend like we got here, or an end of the selling and the beginning of a trading range. In this particular case, we got a bull trend reversal. In either case, you're going to be looking to buy a reversal up, especially above bull bars. This is a pretty dramatic reversal after a pretty strong sell-off. And whenever you get a big reversal like that, it's the dominant feature of the day. The day is unlikely to come back down here. It'll either stay sideways or go up. Cup and handle, a reversal, and then a bull flag. Traders will look to buy the bull flag. They can also buy the reversal, look for bull bars closing near their highs, even that. Another gap down, moving averages up here somewhere, and a series of bear bars. Bears will start to sell below bear bars, betting on a reversal. We're trying to reverse up here, but two big bear bars, probably going to get at least one more leg down. Two more bear bars, a weak buy signal bar, probably not a high probability buy, might get one more leg down. After this big bear bar, this does not look strong enough to reverse that big bear bar. Parabolic wedge, 1, 2, 3, and we broke below the parabolic wedge and got a big reversal up. Bulls will start buying above bull bars here, here, here. First reversal up from a strong bear trend, usually minor. It can often go up far enough to make a swing profit, but usually you need some kind of a test down before you can get a major reversal into a bull trend. We have a higher low major trend reversal here. We got a swing up, but not a bull trend. Ultimately, we got a double top bear flag and a new low. Gap down, immediately tried to reverse up, but we have a high here, sold off, sold off, sold off. So this is a gap down and a wedge rally to the moving average. And the bear trend resumed. It collapsed in a sell climax. And we're reversing up again. So we have a wedge bear flag, opening reversal down from the moving average. And now we have a double bottom, possible low of the day after a sell climax. Traders will take the sell and they'll take the buy. Either take the first bull bar, or after 3 bear bars, you might wait to buy above a second or third bull bar. Pretty good reversal up after a dramatic sell-off. Cup and handle, sell-off, reversal, and then bull flag or double bottom bull flag. This is a dominant feature and probably will result in the low of the day. So that means the day will either be sideways or up. I said that you can get a gap down and a sell climax that reverses up, but sometimes it reverses and becomes a bear flag and the bear trend resumes down. Strong sell-off on the open, bulls trying to get a reversal up. Instead of getting a trend reversal, we got a bear flag and a resumption of the bear trend. Consecutive sell climaxes, every bear bar or series of bear bars is a sell climax. First reversal up, probably minor. The bulls hope for a second reversal and some kind of a double bottom. Instead, here we got a resumption of the bear trend. The bulls hope for a parabolic wedge, sell-off, pause, sell-off, small bar pause, then a third leg down, or nested, spike, and small channel. Bulls buy the reversal up, or they'll maybe buy above here, but bad follow-through. The buy signal bar, not big. The entry bar, not big. Bad follow-through here. Bull breakout here, not big. Bad follow-through here. This looks like a leg in a trading range, or possibly a bear flag. And bears will look to sell below bear bars closing near their lows. So instead of getting a reversal up from a sell climax, the reversal became a bear flag and the bear trend resumed. Now we have a wedge bottom, a bigger wedge bottom, 1, 2, 3. It's consecutive wedge bottoms. We have a parabolic wedge here and a bigger wedge here, and a very good looking buy signal bar. So you have to be expecting a couple legs up. Reasonable to take that buy. Wedge bottom, 1, 2, 3. You expect 2 legs up, and the pullback from the first leg typically forms a higher low, major trend reversal, and a head and shoulders bottom with the second leg down in the wedge. So left shoulder, head, right shoulder, and you expect a second leg up. And here, that's all you got. 2 legs up and not a reversal into a bull trend. We got a new low of the day. The way I look at it is most patterns work 40 to 60% of the time. And that means they fail 40 to 60% of the time. So anytime you see a pattern, no matter how good it is, always be prepared for it to fail and always think about the possibility of taking a trade in the opposite direction when the original pattern fails. I began by saying that strong trends from the open that last all day happen only about once a week. 80% of the time, days have some kind of reversal on the open, usually in the first 1 hour, first hour and a half. I began by talking about how to enter. You should be entering with a stop, where to place your protective stop, and how to exit. I have several hundred patterns, and among that group of patterns, I talked about 2 variations of 2 patterns. First of all, a gap down and a biclimax that led to a reversal back down. Second, a gap down and a biclimax, but instead of reversing down, we got a bull flag and the bull trend resumed. And next, a gap down and a sell-off that reversed up. And finally, a gap down and a sell-off that tried to reverse up, but the reversal became a bear flag and the bear trend resumed. I'm Al Brooks. Thank you for watching this video. And thank you again, Mike and Terry, for having me speak at the Futures I.O. webinar on October 30th, 2018. I'll be taking questions. Terry, I don't know if you want to read the questions. Go ahead.
How would you trade the open in a Forex markets? What time do you consider the open?
In the open, Forex markets are tricky. You have 3 sessions. You have the Asian session, you have the European session, and then you have the US session. Patterns are basically the same. Like, for example, at the end of the US session, the market usually enters a very tight trading range. And then once you see a breakout up or down, to me, that's the open of the Asian session. And then usually sometime around midnight California time, 3 a.m. Eastern time, you'll get a strong breakout up or down. And then I start to look for these patterns again: double tops, double bottoms, wedge tops, wedge bottoms. And finally, the US session, typically it starts around 5 o'clock or 5:30 California time, 8 o'clock, 8:30 Eastern time. And I start looking for the same patterns using today's examples: double tops, double bottoms, and then reversals, or wedge tops, reversal down, wedge bottom, reversal up. And these patterns, by the way, I don't simply look at them on the open. I look at them all day. I'm giving them as examples of opening reversals, but they are standard reversal patterns that occur throughout the day. So let's say you show up in the market has been open for 2 or 3 hours. It doesn't matter, Forex market, I look for these same patterns all day long.
Okay. Would you hesitate to buy above a good signal bar if the EMA is just above your entry?
It depends on context. If the bars to the left are very supportive of a buy setup, I will buy, even if it's right below the moving average. In general, I'm always suspicious. If I see a buy setup right below the moving average, I'd rather have it take place just above the moving average. Otherwise, I prefer it to be fairly far below the moving average. Whenever you get a buy setup right below the moving average, especially if the day has been failing at the moving average for the past 2 or 3 or 4 hours, I typically do not take that buy. But if it's setting up just above the moving average, in other words, it was below the moving average all day, and now it's starting to get above the moving average, and I get a buy setup, I'm more inclined to take that buy.
Okay. How did you discover the 400 patterns you're talking about? Or I guess it's actually 100 patterns, but...
Yeah, 100 patterns times 4. Well, everybody on the planet who trades a lot knows all of them. I just classified them, I categorized them to try to make it so that it's easy for people to follow what I'm saying. If they see what's happening, they can think about what are the implications, what are the possibilities. Remember, I've been doing this, I've been watching every tick for over 30 years. And I collect, I like to collect. And I like to categorize. I like to make things organized. I like things organized in my mind. And I like to have them organized so that other people can understand how to do the same. There's nothing magical or secret about it. It's just that allows traders to become more confident in taking trades.
Okay. Were you adding to your original position with each of those additional entries, or taking quick profits and re-entering with a new position?
It depends on circumstances. If I'm in a scalping mode, if I think that the market is going to have a leg up for a couple hours, a leg down for a couple hours, I'm much more inclined to take quick profits. If I think the market is going to go higher all day or for the next several days, I'm much more inclined to hold for a swing. I tend to be a scalper. I tend to take a lot of scalps. I take fewer swing trades. But in general, there are always going to be far more scalps than swing trades. There are scalps on probably 50% of the bars every day and in every market. Whereas a good swing trade, typically on most days, you get 1, 2, or 3 a day. There have been more lately because the ranges have been so big. But in general, there are far more scalps than swing trades.
Okay. Do you use or recommend a certain time frame, 5-minute versus 60-minute versus daily, etc.?
I've been doing this a long time, and I've done everything. I've traded every kind of chart. I've traded every kind of time frame, tick charts, volume charts, just imagine any kind of momentum charts. I trade everything. And I've traded every time frame. I've traded tick charts, one tick on the chart, line charts, candle charts, bar charts. And for me, what I've discovered over the years is trading has to be both fun and profitable. I think a trader can trade any time frame in any market profitably if they're a good trader. But it also has to be fun. And to me, trading the 1-minute chart is not fun. It's tradable. The patterns are there, but it's not fun. I like to trade the 5-minute chart. Patterns are very reliable. I have time to think. Like the past couple of weeks, even the 5-minute chart, a lot of things happen very quickly. So a lot of times the market will move 5, 6, 8, 10 points in the final 10 seconds of a bar. When you print it out at the end of the day, the 81 bars look pretty obvious and clear, but a lot of times the bar changes its appearance fairly drastically in the final seconds. And it's even a bigger problem on the 1-minute chart. And sometimes you hear people talk about noise. There is no noise in the markets. I view noise as what's happening on any time frame that I'm not trading. So if I'm trading the 5-minute chart, a chart based upon 50 ticks or a chart based upon 15 seconds, 10 seconds, that's noise. It's meaningful, and there are computers placing trades on those time frames, but I'm not. So anything that I'm not interested in is noise. If I'm trading the 5-minute chart, what's taking place on the yearly chart is noise. I don't care. I don't care what's happening on the chart where every bar is 1 year. I'm only interested in what's on the chart in front of me. And I don't want a whole bunch of charts and a whole bunch of indicators. I see, 50, 60, 70 trades a day on the 81 bars on the 5-minute chart. I don't take all of them, but there's so much going on. I'm just thinking all day long. I can usually take a lot of the trades, a bunch of the trades, typically 10 to 20 trades a day. And, that's all I need. You put up a 1-minute chart, you can probably see 100, 200 trades a day. But most of them happen so quickly, you cannot place the trades. Even on the 5-minute chart, when the ranges have been as big as they have been, a lot of the times I'm missing trades. And I don't care. I'm making money. I don't care. I never worry about missing trades. I never worry about not taking trades. I never worry about missing big moves. All I care about is what I do take. Is what I'm doing sensible? Am I doing something that makes sense? Am I managing it correctly? Am I using the right or appropriate stop? Am I exiting at an appropriate time? That's all I care about. I personally, I'm very comfortable trading the 5-minute chart. Someone else might feel it's too fast and they might trade a 60-minute chart. I do trade 60-minute charts, 4-hour charts, and daily charts with options or forex markets. I'll often trade higher time frame charts, bond charts, crude oil charts. I like to take trades on the higher time frame charts. If I'm scalping on the E-mini or day trading on the E-mini, looking for a lot of trades, but I see something happening on a 4-hour chart of the bonds or on gold or crude oil, I might place a trade on a forex market. If I'm anticipating a move in the forex market, I'll often trade based upon a 4-hour chart or 2-hour chart, but look for a pattern on the 5-minute chart or 15-minute chart.
Okay. How do you calculate the math on reversals when the low is so far away? What are good targets?
One of the problems that a lot of traders have had over the past couple of weeks is the bars are big. Like, for example, on the 5-minute chart. Let's say the buy signal bar is 10 points tall. That means the risk is $500 per contract. And if you have a $10,000 account, that's 5%. You cannot take the trade. You cannot risk 5% of your account on any trade. You should be risking 2%, maybe 3% on any trade. And sometimes the risk is very far. At least the initial risk is far. You don't know what the actual risk is until the market goes against you and then goes your way. For example, if you buy and the bar is 10 points tall and you put a stop below, your initial risk is 10 points. And let's say the market pulls back 3 points against you and then goes your way 20 points. You actually only had to risk 4 or 5 ticks to stay in that trade. But you don't know that when you put the trade on. I calculate targets. I'm usually exiting based upon support and resistance and momentum. If I'm buying for a scalp and I have 2 or 3 times my actual risk, I'll get out. If I'm buying for a scalp and the market's not doing what I think it should be doing, I'll get out with a loss or a profit. I took a trade because I expected something to happen. If it's not happening, I don't care what an ideal profit target is. My premise is no longer valid. I'm going to get out. Sometimes I'll take a trade and the market goes my way and quickly fills my initial profit-taking limit order, and it keeps going. And then I say, wow, that's cool. I made a lot of money very quickly, and I'll look to get back into the trade. So as long as the trade is good, if I get out for any reason, I'm looking to get back in. And as soon as the trade is bad, even if I have a loss, I'm going to get out. In my course, I talk about different guidelines to use based upon actual risk and initial risk and multiples of those. In general, a trader should be looking to exit with 2 times their actual risk. So if they actually had to risk 2 points, a reasonable minimal profit target would be 4 points.
Okay. How do you define a scalp versus a swing?
My general rule is if the profit is twice the initial stop, so if you have to use, let's say, a 5-point stop, a swing would be a 10-point profit, and a scalp would be anything less. When the market is a normal-sized market, in the E-mini, let's say the range is 8 points today, a scalp would be 1 point, maybe 2 points, and a 4-point trade or more would be a swing. In the Forex market, most days, a 10-pip trade is a scalp, and a 40 or 50 pip trade is a swing. Crude oil, when the range is small, 10 or 20 cents is a scalp, 50 cents or more is a swing. If you're trading a daily chart instead of a 5-minute chart, everything's different. A scalp could be a move that lasts 1 day, and a swing could be a move that lasts 5 days, 4 or 5 days. And usually, when you're talking about scalping and swinging, you're talking about intraday charts, 5-minute charts, 15-minute charts. If you're talking about taking profits on a daily chart or a weekly chart, people don't use the term scalp and swing. They use the term trade instead of scalp, and they use the term swing or an investment for a trade that they're planning to hold for several weeks or several months.
Okay. How do you define a wedge?
A wedge, I have a very broad definition of a wedge. Usually a market, let's talk about reversals in general. If the market tries to do something twice and goes the other way, it's a double bottom. Sometimes the first or second move down is so strong that you're going to get a third move down, and that would be a wedge. It could be a double bottom and a breakout below that reverses up. To me, that's a wedge. We have three pushes down and a reversal up. But more traditionally, a wedge it's a contracting triangle that's diagonal. So the legs are getting smaller and it's sloped down for a wedge bottom, or the legs are getting smaller and it's sloped up for a top. Some people just use the term triangle for everything. Other people call everything wedges, even if they're sideways. In general, if it's sideways, use the term triangle. Triangle has at least 5 legs, 3 one way, 2 the other way. And a wedge has the same thing, 3 one way, 2 the other way, but it's diagonal. And it does not have to be contracting. If you limit yourself to perfect patterns, you're never going to trade because there are no perfect patterns. You have to be flexible and you have to understand what the market's trying to do. In general, if the market tries to go down 3 times and it reverses up 3 times, I'm going to think of it as a wedge, even if it does not have a wedge shape. 3 attempts in a channel to do something, and all 3 attempts fail, we get a decent reversal bar. To me, that's a wedge.
Okay. There's a question on, let's see, I've read about Al's first years of trading, but I would like to ask him, how did his success come? Was it a sudden breakthrough or did it happen gradually over time?
It happened. It took like 10 years. I couldn't figure it out. The trading world is much more honest than it was 30, 35 years ago. Back then, you'd have all kinds of crooks out there advertising all kinds of stuff and selling it for outrageous amounts. I hired tutors. I went to seminars. I read every book you can imagine. I've tried every indicator. I bought programs that supposedly were guaranteed to automatically generate money trading. And it was all lies. It was all lies. My biggest problem was I knew it's a eat what you kill type of career. If you don't kill anything, you starve. However, I was always looking for a savior. I'm always looking for someone to hold my hand, a mentor, a tutor, a special indicator, someone on TV to tell me to buy this or sell that. That's not eat what you kill. That's eating what somebody else is killing for you. And you're not going to make a living as a trader. And at some point, you have to decide everything everybody's saying, including Al, is a bunch of garbage. And I got to figure out how to do this on my own. I got to do it on my own. And I cannot listen to the idiots on television. I got to make decisions for myself. I got to be responsible for myself and develop enough experience to have confidence in my decision making. It took me about 10 years to realize that the world was filled with liars and thieves, and that Goldman Sachs was not out to get my money. They don't care about me. I don't have enough money for them to get. All of us together do not have enough money to interest any firm. 95% of the trading is done by firms. We're 5%. If those 95% are trying to make a living, they're not looking at us. They're looking at each other. They're not trying to take our money. And it just took a long time to observe what the market is doing and think about why it's doing that. I'm always thinking about why is the market doing something. I don't know if you can see this screen over here. You can see this sell climax. It's a sell to close market. Traders are selling, closing, selling below bars. Then you get a disappointing bar for the bears, right? And I've noticed a lot of times that when the market gets back down to that low close, it reverses the second time. Why is that? You have strong bears who've been selling all the way down, and then they're disappointed by this, and they know the first reversal up is going to be minor, and that it's going to come back here. They sell more higher, and then when it comes back to that close, they decide the trend is over, they buy back their shorts, and that's what causes that reversal, the bears giving up. And I also know that from my own trading, because that's what I do. If I'm selling closes or selling below bars, I know the first reversal up is going to be minor, and that we're going to test down, so I'll sell more higher. And If the reversal up is strong enough, I decide the bear trend is over. I'm going to buy back my shorts, break even on this final sell, and then profit on the higher sell. So a whole bunch of stuff just makes sense. And once I started getting good at trading, I started to realize that what I was doing was what the market was doing. A lot of times, if I'm taking profits, it's right before the market will reverse. And it's because a whole bunch of other people are taking profits there as well. That just gives me confidence to know, what I say is true and what I believe is true. I see stuff all the time. I talk about it all the time in the chat room. And it's just a lot of experience. The other day, I talked about, there were a couple big legs up. I said, we're going to reverse. Another time, a couple legs down. I said, we're going to reverse. I said before yesterday, that we have a parabolic wedge on the daily chart, and either it's going to reverse up or we'll get one more brief low and then reverse up. Yesterday, we got a big new low, but it was brief and we reversed up. And today, I bought calls because I think we're going to go higher. It's a bear rally, but we're going to go higher. And it just takes enough confidence seeing the patterns to be able to trust placing the trades. As I said, 90% of the time, you're never going to be more than 60% certain. However, you can still structure profitable trades if your reward is at least twice your risk. Even if you're only going to be right 40% of the time. You can be right 30% of the time if you go for a reward 3 or 4 times your risk. As long as you structure the trade and manage it well, you'll do fine. For me, I like classifying things, categorizing things. So if I see something happening, I can quickly say, oh, that's a parabolic wedge, or that's a double bottom, or that's a triangle. And then I start to think about what can happen with those types of patterns. What happens when they fail? What happens when they succeed? What am I looking for? What are my reasons for entering? And it just takes a lot of time to learn all that stuff. I put all that stuff in my books and in the video course. I cover pretty much everything that I'm thinking about, and hoping that it helps people who look at that stuff make sense of what's going on and get to being profitable faster.
Okay. With that, I think we're at time. Yeah, we're at over an hour. So thank you for the webinar, for the information, and for spending some time with us this evening now.
Okay, I appreciate it, Terry. I want to thank Mike as well. I also want to thank everybody for listening in.
Absolutely. Thank you.
Okay. Good night.